Hello and welcome to the webinar. My name is Julia Goebel and I'm Chief Marketing Officer of Benefit Express. Thank you for joining us today for our topic, Benefit Issues Raised in Mergers and Acquisitions. A few housekeeping items before we get started. If you missed something, don't worry, we'll be emailing you the recording as well as the slides after the webinar concludes. I'll be keeping the webinar muted throughout to avoid any background noises. And we'll pause throughout for questions. Simply type your question into the questions box on your GoToWebinar screen, and I'll read it aloud for you. If we don't get to your question today, we'll be sure to email you a response. And now I'd like to talk through our topic. We'll be taking a deep dive into common employee benefits issues raised in mergers and acquisitions. I find this topic personally very interesting. In an earlier role in my career, our company was highly acquisitive, making almost 500 acquisitions in 25 years. Now, acquisitions come in all kinds of shapes and sizes. Many are tuck-ins, but some can be product line extensions, requiring a whole consideration of the business. And with that comes a variety of people matters. And in every company, we focus on compliance. So with that, we're very excited to hear our topic today. 2019 is poised to be another big year for M&A activity.
What is the problem?
But once the ink dries on the M&A agreement, resource-strapped HR departments often find themselves faced with an overwhelming task. They must unite new and existing employees around a common benefit offering that will likely represent change for all. Involved in the process is an analyzing of needs, building the right benefits package, and then, of course, an infrastructure to support rollout and employee education. For many human resource professionals, an M&A project may present itself only once or twice in an entire career, or for others, more frequently. However, these events are routine in our world, and we are here to help navigate. Today, we've brought in ERISA attorney Larry Grugin as our distinguished presenter. With more than 35 years' experience in employee benefit law, Larry has a wealth of experience dealing with qualified plans, health and welfare, fringe benefits, and executive compensation areas. Thank you for joining us today, Larry. We are thrilled to have you.
Thank you.
And with that, I will hand it over to you to take it away.
Thank you very much. What I'm going to try to do today is talk about how mergers and acquisitions affect benefits. We're going to be talking about the types of transactions, steps to consider in getting ready for a merger and acquisition, and the effects on various benefit programs. I'll be talking about health plans, other health and welfare plans, other benefit issues, retirement plans, control group issues, how mergers and acquisitions will affect that, executive plans, management issues, what you have to do to really satisfy the due diligence requirement. I'll be talking, and then I will summarize everything with a series of slides on summary of actions, and then in regard to, and then we'll again summarize and end with questions, but again, they will interrupt me all the way through the presentation and take questions. First of all, we have to look at, and it's important to figure out what type of transaction you have. A stock purchase generally is when a stock is exchanged and sold. And basically what you do in that situation, you basically step in the shoes, the buyer steps in the shoes of the seller. You become the seller. Asset purchase, you don't take any liabilities in what you're doing, you're just purchasing assets. Basically, it could happen that the employer the seller will actually may stay in place, that they may just be selling a piece of it. Mergers in a situation where two companies merge together may actually put together a new entity. I'll be talking about acquisitions, what that is, and then in some situations we call spinoffs. And that situation is when the existing company, they want to spin off a division. That's what that is. So let's look at each one. And we'll be looking at each one in later in this webinar. We'll talk about the benefit plans affected. We'll talk about the retirement plans, cafeteria plans, health and welfare plans, other benefits, executive plans, and COBRA. So all these are going to be affected by the transaction. Now let's look at the stock purchase. The stock purchase is the buyer is buying the entire stock of the target. All right. And the target will either disappear entirely or as a subsidiary of the buyer. The target employees become the buyer's employees at the closing. Okay, so that could happen. And what's important here, and the reason why it's underlined so important, the buyer assumes all obligations and liabilities of the target. So basically, you're buying everything. And there's any issues or problems with the seller, all that is going to be your problem now, and that's going to be the issue. Now let's look at an asset purchase. In this situation, the buyer is purchasing certain assets of the target. It can be the assets of the target leaving behind a shell of the corporation. It can be a particular location or division of the target. And the target employees remain the employees of the target unless it's hired by the buyer. So in this situation, these employees will become new employees of the buyer. And the target retains all the responsibility for the benefit programs, with a few exceptions. But basically, the target could remain in place, and it could continue all these plans. The buyer could assume some of these plans. So basically what you have to do in this situation, if the buyer wants to assume any responsibilities, they have to then assume those plans. That's what has to happen. Following the closing, what happens to the target? Well, under a merger and acquisition situation, it could be absorbed within the buyer, a merger, treated like any other division, same buyer, benefit structure generally. Or in this situation, under a merger and acquisition, it gets standalone business acquisition with a separate benefit structure, or again, depending on what you're doing, with the buyer's benefit structure. So that could happen in that situation. So that's when you have mergers and acquisitions. On a spinoff is there's no other entity involved. And what is generally the situation, the company decides to spin off a division. That's what you have. It could be often sold to the management of the division, being set up a possible future sale. So, and that's the most common situation. It could be actually an asset sale where you basically, you could either be a stock sale or an asset sale. And in this situation, asset, they're just buying the structure, maybe a building, maybe the assets inside. Here, the benefit programs could continue in the parent company plans, or you could establish new plans. That could happen in that situation. Now, what is it? And this is happening over and over and over in the situation. Negotiation had been taking place for weeks behind closed doors. Nobody knows. And what's very common is no one has informed HR regarding the deal until it's almost done. And what's typical is the HR will have a few days or a week to prepare all the changes. And so you have to be very, and the reason why this is done, is the fact that in some of these situations, the deal falls through. So the less that everybody knows what's happening until, again, the papers are signed, the better it is for everybody. But the problem is once the paper's signed, everybody has to act very quickly to make sure the changes are done. And as this last bullet here is, be careful, deal can collapse at the last minute. I was recently involved in a situation where the closing on the asset purchase was delayed 7 times because They couldn't get financing. There were final details that weren't that couldn't be negotiated. So, I mean, this is a very interesting situation that you're involved in. So basically what you have to do at first step of the process, you have to inventory the plans. What does the target have? What are the plans they have? You have to collect all the plan documents, collect plan data, and before the closing, there has to be a decision on the fate of the future plans. Are you going to assume them? Are you going to take them over? Or will the seller terminate them before the actual transaction? So some things must happen before the closing. Planning has to happen before the closing. What are you going to do? How the employees are going to be treated. And then generally, some things cannot happen before the closing. So again, you have to differentiate which situations are which and decide what can be what can be done before, what can be done after. Now, employee communications are extremely important. Be careful when to communicate, because until the deal is done, you cannot communicate anything. And people get very nervous, employees get very nervous because of the deal. So deals fall through or change. Keep rumors at a minimum. Prepare a variety of communications based on possible alternatives. All right, so again, the deal could switch halfway through. And what's important, HR must work with senior management in preparing any communications. You have to make sure it reflects the most recent deal. Now let's look at specific plan assets, particular issues depending on the type of plan involved. Pay attention to plan specific, look at the plan documents, because you have to understand what you're getting into in order to explain to the new employees exactly how their old plans compare with the new plans. Carefully review all administrative contracts and insurance contracts, and in some situations, the buyer may not be able to assume those contracts. If there's a change in control situation, there could be a termination of the contract. And also what you need to do is review possible state and federal notice and disclosure requirements before and after a transaction, because if a number of employees are going to be terminated, the problem in the situation is the fact that there may have to be a warning to the state, the fact that so many employees are going to be terminated. And also too, there's a certain notice requirements under the ACA. If there's changes in the coverage, especially health coverage, there has to be a 60-day advance notice. So if health plans are self-insured, stock sale, buyer assumes liability for all health plans unless terminated before the transaction. You step in the shoes. Is that plan documentation in order? Are there actual plan documents? All reporting, notices, and disclosures, have they been completed in this situation? And how does the level, and this is important, how does the level of benefits compare with the buyer's plan? Because you could have some employee issues if there's substantially more or less. So you have to make sure you compare them, and in the communication, make sure that that's taken care of. On the asset sale, liability stays with the seller. Will the seller terminate all plans before the asset purchase happens? Will all required notices given to the employees? And again, if there's a termination during the year, you have to give the employees 60 days advance notice. That's extremely important. Key questions regarding target plan if assuming are, and especially with health plans that are self-insured, are there significant funds to cover incurred but unreported claims? Are assets held in Aviva? Because if there's assets there, who's going to get them? In this new situation, is the stop loss coverage adequate? You have to really talk to the stop loss carrier to find out exactly what the situation is. Are there any future large claims made but not paid? And if you're suing the plan, especially in the stock purchase, is that going to affect the coverage in the future? And under COBRA administration, you have to determine whether there's any offers outstanding. Merge the buyer self-insured plan. That could happen. You want to merge the plan in. There are any issues with the stop loss coverage? Can your coverage take care of those additional? Are there any administrative issues? Eligibility, things that could again be qualification issues. And in regard to reporting, have they filed all their 5500s in the past? Possible claims administration. If you're merging with a plan, can your current plan administrator administer these additional individuals? And again, are there any possible issues with any non-discrimination and testing issues? Because there's certain requirements you have to meet, especially in the eligibility test. And sometimes you can delay those tests for a number of years. And again, are there any retiree medical offered out there that's lurking that were promises that were in place years ago that you have to meet? So you have to look at those. Stock sale. Buyer assumes insurance contracts. Are there any issues with the insurance company? You have to check the contracts and assuming those contracts. How any transaction affect the renewal, especially if during the year as there are going to be any issues. And again, you have to check the level of benefits. You have to compare it to the buyer, because if you're going to continue the benefits after the sale, how is it compared to the buyer's benefits? Asset sale. If the seller retains or ends the contract, how will the sale affect assumption of the plan? Will the insurance company allow it? Seller notice requirement to terminate contract. Is there a requirement that the contract has to be terminated, or notice has to be given after so many days? That's extremely important to understand. In regard to fully insured plans, does the buyer want to cancel the insurance policies and merge the participants to the buyer's plan, or will the buyer want to assume the contract? And again, if you want to assume the contract, you need insurer's approval. Are there any questions with the insured plan with administration or reporting? And you have to check the contract for any notice requirements if there's a change of control. That's extremely important to understand. And again, are there any insured retiree medical plans? Now, especially with health plans, are the target plans grandfathered? And that's going to be very important, because if you make any changes to the target plans, you could, in this situation, lose your grandfather status, and it could affect the coverage. Does the size of the target make a change in the ACA rules that apply to the buyer? Because as soon as, again, you acquire the new employees, it's going to affect whether you're a large employer or not. And if there's a spinoff, does the change in size of the remaining company make them now a small employer so they don't have to do reporting? You have to decide whether the target has paid or played in the past to decrease your liability. Has the target completed all disclosures, notice, and reporting required under ACA? Because there's huge penalties under the ACA if none of these things are done. If you're assuming the plan, you step on the shoes. So so for employee issues, if it is decided to change the health plan as a result of the transaction, then with a level of benefits change significantly for the employees, is there going to be a massive change, and then you're going to have employee morale issues? Will the deductibles, copays, and coinsurance carry over or start over? And also, will the networks change? Will you have employees or dependents in mid-treatment, and all of a sudden now their doctor is no longer in the network? Will there be any changes in the drug formulary? I mean, drugs that employees are formulary, drugs that employees are currently taking and now won't be covered by your plan. And also, if it's an asset sale, will the buyer waive all waiting periods? Because remember, under an asset sale, these employees will be treated as new employees, and so therefore you have to change your eligibility requirements under an asset sale. For COBRA coverage, the liability depends on whether it's a stock or asset sale. Under a stock sale, buyer assumes liability for all those on COBRA that are terminated. Under an asset sale, the buyer can contract out of COBRA, but only if the seller continues the health plan. If the seller terminates all health coverage, the buyer is responsible for the COBRA to terminate employees of the target. So you have to look at the sales contract to see exactly who is responsible for COBRA. Also, getting back to the stock sale, for those employees that continue employment and switch coverages, that won't be a COBRA qualifying event. It's extremely important to understand. Under a health FSA, stock sale, buyer assumes plan regardless of whether they're currently over or underfunded. So you can continue, terminate, or merge in the future. You can decide, but again, these decisions have to be made before the sale. The effect of transaction on non-discrimination testing. Are you decided to test them together, or have you decided to test them separately? And you have to check the requirements for assuming the TPA contracts. Are there going to be certain notice requirements that you have to adhere to in order to, again, assume the contract? And then basically what you have to do is, if you're going to assume the health FSA, are you going to amend the documents and disclosures to assume the plan? So under a health FSA, in regard to an asset sale, buyer and seller have three options. Seller retains participants on a seller's plan. Buyer transfers deferral to the seller's plan under COBRA. Buyer could assume the seller's plan. The participants could transfer to the buyer's plan with the transfer of assets and liabilities. In that situation, there could be no change to participant deferral rates. Again, will the buyer in this situation, an asset purchase, will they waive all waiting periods? That's extremely important to understand. So under a stock sale, under other situations, will the buyer assume plans at the closing and decide when and if to terminate them? Because remember, you're stepping in the shoes. Are you going to put them on your plan? Are you going to transfer insurance contracts, check contracts for requirements? If any benefits are self-insured, effective transaction and non-discrimination testing. You have to check documentation, notice, and disclosure requirements. And you have to decide under what situation, if certain employees won't be employed, COBRA will be offered under what benefits. So if they offer medical, dental, health FSA, it's going to be extremely important. And again, for an asset sale, the buyer has no obligation to continue any benefits. They could, again, immediately go into the buyer's plan. The buyer could, for example, assume benefits for a limited period of time. So you have to check requirements for assumption before the closing. Can certain benefits be assumed? And if the buyer does not assume the benefits, will the buyer waive all waiting periods? Because remember, under an asset sale, these individuals will then be new employees, and if you have waiting periods for new employees, you're going to have you have to change the terms of your plans in order to do this. And check and see if COBRA needs to be offered. You have to look at your purchase agreement in this situation. Also, you have to determine, will the transaction change compliance for family medical leave? Because remember, under family medical, you have to be 50 employees. Are any employees of the seller on family medical leave? Also, you have to check any past compliance with family medical leave. Also, extremely important, workers' comp compliance. Are there any outstanding settlements where employees still on benefits offered COBRA? There was a situation I just been involved where somebody and people assume that workers' comp is coverage, so you don't have to offer COBRA. No, there's a change in hours, and therefore, if somebody is on workers' comp, you should offer them COBRA. Also, Medicare secondary payer rules. Will the transaction change compliance? Now you're over, under 20, or 100. How that will affect your situation. And make sure, and this is extremely, we're all reporting and disclosures done for Medicare secondary payer rules. That's important also to determine. And were any dependent audits done in the past? Especially if you're assuming a very large number of employees, there's some problems lurking out there. Also, you have to look at vacation time. If you're, especially in an asset sale, the accrual rate. Are they going to come in as new employees? Are going to be getting credit for past service? Special considerations for the year of transaction. Sick time, are they going to get additional accruals for sick time, especially in the year of transaction? It's extremely important. And again, as I say, there are special considerations for the year of transaction. There could be a myriad of other employees, especially if you have troubled employees that you're going to assume. As part of the deal, are you going to assume all employees? Are you going to interview each employee? And you have to ask if when any of those employees are on probation or have issues. All this has to be taken care of. Let's look at 401k issues and control group issues. Stock sale issues. You have to check the qualification of the plan, qualification status of the plan, because now, since you become owner of the plan, you are their problems and now your problems. You have to look at the appropriateness of the investments, because there's been a myriad of litigation in this area. Are there any outstanding issues? There's a correction program called EPCRS that you can then force the seller to go through in order to make sure these plans are correct. How has been the quality of plan administration? The plan fees, if you're assuming a plan, are there any fiduciary issues that you're going to be walking into? And look and see if all the non-discrimination testing has been met. Also, reporting and disclosure requirements. It's very interesting if 5500 has not been filed, and all of a sudden you have 5, 10, 15 years of issues with 5500s. So these are things, again, you have to look at. Also, for 401k plans, non-discrimination testing. Under a certain section of the Internal Revenue Code, you can maintain separate plans without testing together for the year of acquisition and the following year. If you pass the test before, no problem. Must have separately passed tests before the transaction, and gives the buyer especially time to merge the plans and may run them separately for a period of time. So at the transaction period, again, there's nothing wrong with maintaining separate plans, but after a while, there's certain combinations, and you must do a combined test for certain reasons. So you can have separate plans, but for determining who is highly compensated, who is non-highly compensated, those have to be determined after the transitional period. They have to be tested together. So here are the situations. Here are the options. If you want to maintain two plans where the employees move between two divisions, that's the issue with maintaining two plans. Merge plans. Are there going to be, or terminate one plan or freeze a plan? Under 401k plans, there's protected benefits. There's plan feature issues. There's investment issues that you have to look at. You cannot terminate a plan after the stock sale if an existing 401k exists. A 401k is established 12 months following the disposition of the assets, and there's a successor plan. There's not an issue in an asset sale. So you have to make a decision before the transaction, before the closing. What are you going to do in this situation? And it's much easier in this situation for the seller to terminate the plan, and then you can then accept rollovers in the situation. Also, various plan features. You know how your plan compares with the buyer's plan and the seller's plan. Was it a safe harbor plan? Were there Roth contributions? Did they accept Roth conversions, loans? If a plan is terminated in many plans, plans become due. And there's certain situations an employer, the buyer can assume loans. Where there's self-directed investments, there could be fiduciary issues in regard to that. And also 401k investments, stable value fund, liquidated transfer, real estate, limited partnerships, insurance contracts, company stock, and don't forget the blackout period. All these could cause investment issues under ERISA. So you have to look at this to see, because especially in smaller plans and smaller employers, there could be special deals with the owners where they could invest in anything they want. And this is something you have to look at. So control group issues. Existing control groups may longer exist after the transaction. New control groups may be created. So it will impact highly compensated key employees, plan structure, testing, reporting, and especially for multiple plans and MEWA issues, especially if they're now employers are no longer covered in this situation. Okay, so if people that are not in your control group are now covered by the plans, there could be an issue with being a MEWA, multiple employer welfare arrangement. Non-qualified plans, there could be special deals with executives. Is any documentation available of these special deals with executives? Was there promise in writing? Was there funding available, life insurance? Are there any company-owned life insurance contracts? These are all executive plans, and many small companies have these. Were there any split dollar insurance plans? And what's extremely important, were there control group, was there change of control issues where now there has to be payout because there's a change in control? Stock sales, were there any buy-sell agreements, employment contracts, severance agreements, special benefit arrangements? And are you going to enter into employment contracts with select management? Are there any special benefits to assume? So here in a due diligence and stock sales, are any buy-sell agreements, employment contracts, any severance arrangements, special benefit arrangements with executives? Asset sales, are you going to enter into employment contracts with select management? Any special benefits to assume? With other health and welfare plans, documentation, 125 tests, COBRA administration, reporting and disclosure, short-term disability, payroll practice or insurance contracts. Are there any clear, or any of these benefits instead of ERISA plans, policies? And other issues to consider: family and medical leave, Medicare secondary payrolls, and workers' comp. So this gives you some ideas of exactly what you have to do in these asset purchases. So in summary, you have to set a strategy early, especially when the terms are set, gather full and complete information on all employee plans, evaluate plans, identify issues, possible conflicting factors, develop and implement process for the entire benefit structure, confirm the understanding with senior management so they understand, so they're not going in a separate direction. And what's extremely important in this situation is manage employee communication. That's what's extremely important to understand. So are there any questions for what I just went over? Julia, are there any questions?
Larry, we've had a couple questions throughout the session about the access to webinar notes. So everyone, after the webinar, we will send a copy of the presentation as well as a link to the recording, and watch for that in the next business day. At this time, we are opening the line for questions. Within your GoToWebinar window, you have a section that says questions. Here is where you can type in a few notes or ask a question, and we will be happy to answer that. We'll give everyone just a minute or two to answer some questions as we prepare to conclude our conversation.
And are there any other issues or areas that we didn't cover that you have a question in regard to?
Yes, now our question window is open. Please go ahead and reach out with any questions. Great. So while we give everyone a moment to consider or ask a question, I want to ask you, Larry, one question. You know, certainly you've had an opportunity to advise on transactions over time. You know, what is one common thing that you see that is perhaps a tip you might suggest HR leaders consider when they are involved in a transaction or perhaps after the fact?
Clear communication between the senior management and HR. The problem in mergers and acquisitions is benefits are the last thing they consider. And they think it's just a throwaway, something that's not really important. You have to make sure the senior management understand that benefits are extremely important, and HR has to be involved early and often, because employee communication and benefits are going to be extremely important to understand. And if you are brought in the last minute, it causes all kinds of issues and problems. So I think communication with senior management, understanding what the deal is, understanding what you're getting into, I think is extremely important.
That's great, and I think that, you know, communication is clear. Is helpful no matter what the matter, but certainly especially in this case.
Yes.
I do have a question to share from Christy. Christy asks, is there a reference document that is available for quick reference? And Christy, we will be sending a copy of the slides, but you sound like you're asking for something brief. Larry, what do you think?
Well, I have some checklist items that I could send you, that you could send to the attendees. So you have some ideas exactly what the issues are.
Mm-hmm. That sounds
so
great.
I could do that.
We will plan to collaborate on that, Larry, and we will share that back out after the fact. And thanks to Christy for the question. I have another question from Amber R. Amber asks, any advice for when the buyer finds out that the target did not do a 401k audit when you go to file the 5500?
Well, that's going to be reflected. That's going to be reflected, especially if you take it over on the either asset or stock price, because that has to be something that has to be considered in the closing as a cost. So if there's any aspect of the 401k plan or in the health and welfare plans that have to be considered, that can be a factor in determining the asset or purchase price.
That's great. Okay, and thank you for answering Amber's question. We do have another moment or two if there is anyone else who's maybe considering a question but waiting to ask. Now's your chance. And if you have a leftover thought, as I like to say, later in the day, or once you've received the slides, know that you can always reply to the Benefit Express email that sends you webinars, and we will be happy to help with that. Great. So with that, Larry, I believe we've answered the questions for the moment. Anything else you'd like to add before we wrap up?
No, just I think review the webinar slides very carefully. It covers a lot of areas. And if you have any questions, this is my contact information, and I can assist. Again, thank you very much for having me.
Absolutely. And we want to thank all of our attendees for joining. Once again, Julia Goebel and Larry Grugin signing off. Thank you. Bye-bye.
Bye-bye.